Hey, this is CatsMeow492, and this video is going to be about how to plot supports and resistances. So what are supports and resistances? Well, you need to understand three things to understand supports and resistances. 1. Markets have a long memory. Things that were significant before are probably significant now. 2. They tend to repeat patterns. And 3. These patterns obey rules often found other places in nature. If we understand the memory and the patterns markets repeat, we can make meaningful predictions about what they'll do in the future. There are three primary ways to plot supports: reversal, Fibonacci, and my favorite, accumulated volume. Let's get into it. So instead of wasting time with doodles, I figured we'd just get right into charting. So the first method is the reversal method. When you're doing reversal supports and resistances, you're literally just looking at where the market has reversed momentum. Now you can use momentum indicators to do this, but honestly, it's very intuitive. And if it's not intuitive, then you're in a little bit of trouble. So you can see here, these are 2 trading days. When we try to figure out where the support range is for these days, we're literally just looking at where the market price has bounced. You can see here there's a potential support because it's just bounced off this area around 250 2 times. This is a very intuitive way, like I said, to do supports. It's very noob friendly. You typically go to the bottom of the candle here and there you have your support. Now the problem with this method is it's very reactive. It's not very predictive. So let me show you what I mean. You see how the market bounced off here once? Well, we can't really establish that as a support. If we were alive on that trading day, we wouldn't see this candle yet like it bounced. All we'd see is this. So we have no idea it's a support yet. We don't know whether it's going up and down. So it goes up here. All right, that's great. How far up is it going to go? Do we know, right? The candles are still ticking in. Well, there we got a couple red ones. We got a big red one. We got a green one. All right, so now we're trending down. Are we going to continue trending down, or is it going to go back up? So finally we see it bounces here, right, off the support, and then maybe at that time we could determine it's a support, but no sooner. Do you understand how that is not predictive? That's reactive to the market. So we can't even take advantage of this support until after it touches it a third time. And then you can see it doesn't go back to that support. The next day it gaps downwards. So it's not really that useful unless you're looking to just take advantage of that one entry. And you're lucky if you get that, because it could just sink under the third time, or it could rise. It's really only slightly better than a coin flip. So I'd say when you do these kind of reactive supports, this reversal support, it probably gives you about a 75% chance of getting into a good position, maybe even lower, probably like a 60% chance. If you had picked up here, maybe you could have sold stock off at the end of the day, and that's maybe the one good trade you got in where you knew what was happening. All right, so the second method we discussed was Fibonacci. Now, Fibonacci is much more predictive than reversal supports, but it's far less accurate, and it's very interpretive, and there's very limited usability for it. So let me show what Fibonacci is. And I found that Fibonacci is only good for really gigantic price movements. So you can see in recent history, we have a very low crash here and a high here. Now Fibonacci is based off what's called the golden mean. It's a pattern that exists in nature, and I'd encourage you to Google it. I had a picture of it just earlier in the chalkboard video. It's just this tendency for natural systems to retrace in proportion. And it's built into most trading platforms or technical analysis platforms, so you don't have to do any complicated math here. But how you get a Fibonacci retracement grid is basically you find the lowest low in recent history and the highest high, and you just plot it just like this, right? And we're assuming that this is the bottom. And you can already see how Fibonacci makes really big assumptions. We don't really know where the bottom is. I'm sorry, I'm telling you the downsides of this method before I tell you how it's useful in any way. So the Fibonacci retracement, you can see it's kind of got this gradient of values here, these percents, right? And these percents kind of give likelihoods for when it reverses, where it will reverse to. So say if we bounce off here as a support, this acts as a support, we have a 78% chance of reaching here. So you can see how that gives you a useful take profit target. And if it gets above that, then we count that it turns from a resistance into a support. So this is the new support. But after it bounces off here, it has about a 61% chance of hitting here, 50-50 of hitting here, 38% chance of hitting here, 23.6% chance of hitting here. So this can be a good indicator to use when you, or not an indicator, a good method of plotting supports and resistances when there's been a big market swing and you really don't know what's going on. All the other supports and resistances haven't really been useful, and you're looking for a decent educated guess. That's all. That's about all you're going to get out of Fibonacci. All right, the last one, and the one I found most useful, is volume accumulation, which is really just a fancy way of saying looking back at the chart and figuring out periods of very high volume and plotting those as support and resistances along the current price range or the previous price range it was at during those particularly high volume areas. The reason why I find this more useful is it's predictive, right? So we don't have to wait for the chart to bounce off a certain area a couple of times before we determine it as a support. It's kind of got more of a solid basis in, let's just say it's less interpretive, right? People have bought and sold at these areas before. It stands to reason that they'll buy and sell in these price ranges again. So we're not just hoping we've picked the right bottom as we are in the Fibonacci sequence. So I'll show you how we go about that. So this is just a vertical line support, and we go down here to these areas of high volume, and we just look at the candles associated with them and plot them along these candles. So let's say we've got one here, and the other neat thing about this is these can actually, as kind of part of the plotting process, give you an idea of how strong of a support or resistance they are. So when we look back in the history, we look at these volume bars and we can see how the volume compared with other volumes throughout the history. So you can see this area is a moderately high volume area, but when you compare it to all these other volume spikes, it's very small. So we can kind of stand to reason that this is going to be a minor support. And you can see the market's actually hitting it right now. So that's what I mean that it's predictive. This area was significant before, and as I said earlier, if it was significant before, odds are it's significant now. And you can see the market is responding to that. We've had a green bar here. It doesn't mean it's not going to break through. Supports and resistances aren't 100%. All I can really say when I plot a support and resistance is there's probably a 90% chance that the market is going to be at least indecisive at that point. So we've got this one here. You can plot it mid-bar or bottom bar. Some people do a top bar. I don't think it's really useful when you do top bar. So we're going to go for bottom bar here. And then we're going to do these all in red, and we'll see the lighter red it is, the more significant it was. All right, so we're going to zoom out again, find the next one. You can see the next really high volume area is right here. So we're going to look at the bar associated with that. You can see this was one of high significance, or moderately high significance, but the market has already broken through that. If if you remember what I said about the Fibonacci, what I said about the Fibonacci is true here. Former supports become later resistances once they're broken through. And then former resistances become supports when the market is over top of that. So right now we kind of have a channel. We've been playing this channel pretty much all week. Around 240 to 243 range is our support. And if we go on the 1 minute chart or the 1 hour chart, we can see it's just been continually bouncing off this support. So this support has been predictive and useful for finding entry positions. You can see bounced clear off right there. And then this will be our future resistance. So I'm expecting it to bounce up and down in this channel until it kind of makes a decision whether or not there's been enough bad news to move downward, or if there's enough confidence in the government or whatever news catalyst could possibly exist to move it upwards. Now, when you have a market price that's in between a support and resistance like this, and it's fairly high volume like it has been, this is called an accumulation area. People are accumulating their positions, waiting for the market to decide where it wants to go. All right, so let's continue with our supports and resistances. So we have this one, we have this one. It looks like this is another area of very high volume. So we're going to go ahead and put a horizontal line here, and we'll see how does this volume compare to the other two. It's a little higher than this one and much higher than this one. So we're going to make this a different color red just so we can distinguish how significant it is. Here is a couple areas of moderately high volume, but at this point we're getting so low that these are all the supports you really need for the time being to figure out what your next move is going to be. Any higher than 260 is kind of uncharted territory. We've got some real, maybe very minor, super minor resistances up here. But until there's a huge reversal, I don't see any need to plot those. And if you're very confident in SPY getting under 200, I personally don't think it will. You can go ahead and plot more supports over here. And then one additional way to decide, not necessarily plot, but to get an idea where support is a real great indicator for determining support is the moving average. Most people use a moving average of 200 and then a 50 to kind of plot some long-term supports. And this really only works as a very reliable support on either the weekly or the daily chart. And you can see, even as a support, it's already broken through the 200 moving average here. So we are under the moving average supports. In this instance, it's not very useful, but the support happens to be right at this resistance now, so it's really just confirming our idea that there's resistance here. All right, well, those are the most common techniques I know. Those should be enough to get you started. If you are looking to use the program I'm using, this program is called Webull. It's also a broker. There is a referral link down below in the video description, as well as my Twitter and everything else. Thanks for watching. I hope this helped. If there's anything else you want to learn, the next video I plan is how to determine risk to reward and whether or not a position is worth taking. I should have that out by tomorrow, Wednesday. So check in again. Thanks for watching. Take it easy. Good luck.